Going on in the Yardi report, they always cover some single-family rent growth as well. So it's not just multifamily, but single-family and build-to-rent segment falls to a decade's low. Continuing on with the Yardi report, nationally, advertised rates for single-family built-to-rent units fell $15 to $2,194 in September, unchanged year over year, basically no growth. U.S. single-family rental occupancy rates were strong at 95.1% in August and unchanged year over year. Occupancy was 96.3% at RBN and 94.9%, that's renters by necessity, and 94.9% at lifestyle properties. Goes on to say that single-family rentals hit a rough patch in September as the $15 decline marked the worst month since February 2015. Looking at some of the markets that are still doing all right: Twin Cities, Kansas City, Chicago, Columbus, San Antonio, Grand Rapids, Greenville, Charlotte, and then some of the year-over-year occupancy changes. Jacksonville saw an increase of occupancy, Miami, Charleston, San Antonio. I think this is all due to supply. We're talking about whether it's multifamily, single-family rentals, and rent growth, a slowdown in rents, and a slight increase in vacancy, dip in occupancy is attributed to supply coming online. But that supply is slowing down. We've got some graphs in the MBA report that we can get into a little bit. But first, I want to finish up this Yardi report and talk about some of the employment and supply trends and some forecasted rent growth. But really, the most important thing on here is the T12 completions as a percent of the total stock. And what that means is how many new apartments did we actually complete relative to how many apartments exist. A lot of apartments were built in New York City. It's taking the top spot on rent growth, but also one of the top spots for completions of delivering new supply as it needs all of a sudden. 3% was completed as relative to total stock. Again, that's a relatively low number. We saw numbers as high as 12% in some Sunbelt markets about a year ago, and we still see some relatively high numbers in some Sunbelt markets. Austin is still at 8.6% completions as a percentage of total stock. Phoenix at 5.4%. Both of those markets have been posting negative rent growth, as well as Denver here. 6.4% completions as a percent of total stock. Again, not surprising. Year-over-year rent growth in those markets are all -3 to -4%. I mean, you can see the relation. Now, this is lagging. Obviously, rent growth year-over-year is rent growth, from today versus last year, as opposed to we're delivering today. That is, deliveries today add slack for a prolonged period of time, which that's really what we are dealing with right now. A key factor is that more than 525,000 units are in the lease-up phase nationally, which intensifies competition among properties. Markets with the weakest rent growth are often overlap with these carrying the largest pipelines. We talked about Dallas, Phoenix, Charlotte. This is a factor that we're going to be living with for a period of time. And a lot of syndicators, a lot of owners, a lot of investors, we are excited to move on to an area, a more normal environment. And so when we see permits starting to decline, you start to hear this narrative of things are falling off the cliff. Starts are falling off the cliff. Permits are falling off the cliff. Supply is falling off a cliff, which implies that the cliff is right in front of us. And it's not like a year out or 2 years out. Because when we do look at these numbers, like they are declining. They definitely are declining in terms of, again, like the year-over-year permits, year-over-year starts. I'll have to go through the MBA piece to find the exact page. Basically, like multifamily, I think permits, we're down basically 20% year-over-year, and then compounding on 20% again. So like we are definitely coming down. But it's a slow cascade. It's not like it's going to fall off a cliff. It's going to be rolling. And as it rolls, all of these leases don't just get signed at full market rents right away at pro forma. it takes a period of time for them to be absorbed into market. And through that period of absorption, those owners make decisions to potentially lower those rents to accelerate their timeline to get to permanent financing or sell the property, or basically de-risking their development investment. And that puts downward pressure on the rest of the market because the incentives are different. I might have the incentive as a property manager or an owner of an existing stabilized asset to cash flow the property, to achieve slightly higher rents, try to get my expenses down, to increase my net operating income over time for cash flow, kind of your standard strategy. But if you're a developer, you may not care about cash flow at all. In fact, you may have told your investors they're never going to get cash flow. You just told them that you're going to return their capital and a multiple in that capital within a period of time, usually about 2 to 4 years, plus or minus. And as we're getting into that second, third, and fourth year of some of these development deals, the cost to hold on to these properties is increasing because they're on these construction loans that are very variable rate, floating rate. And so their return goes up the quicker they can sell it, especially since IRR, the return metric that most investors use, is time-based. So the shorter the hold period, the higher rate of return. If you have a sophisticated like profit split structure that's IRR based, the sponsor or the GP will make more money the faster they sell it. So they don't care necessarily as much about getting the highest rent or even the lowest expenses. They need to have a couple months of a financial statement, a track record that a buyer can take to a lender and get financing on, there's a big gap there right now. But other than that, they could care less about what they spend or really what the rents are, as long as that next buyer can justify that purchase price. And that is where the gap is, because what many of these developers have had to do is lower rents or put concessions on to get their property leased up, to get it up to 90% occupied, which you can then take to a permanent lender like Fannie Mae or Freddie Mac to get financing on. But when then that buyer, somebody like us, takes that financial statement to Freddie Mac or a Fannie Mae, they'll take a look at it and they'll say, well, these rents aren't nearly as high as they should be to justify the loan. And you could turn back to them and say, well, they were in lease up. They gave big concessions because 3 other properties in the market were in lease up, and now they're all occupied and they're getting rid of their concessions. But Fannie Mae and Freddie Mac, especially Freddie Mac, they're looking at that financial history. They're looking at the last typically 12 months of history and saying, no, well, you can say that you have a business plan to increase these rents, but the current owner sign leases at this amount, that's exactly what we're going to give you credit for. And that is what is adding to this bid-ask spread between what sellers would like to sell their properties for and buyers. And so we're going to be in a period of working through this slack, getting back to new deliveries, supply, and a slowdown of rent growth. We're not out of the woods yet, but we certainly are at a point, we're near that low point in terms of rent growth. We're not seeing an acceleration of supply, but it's not going to be the quick bounce back that everyone is hoping for. Now, maybe we'll get a recovery from this uncertainty. I'm not confident in that because I think it's part of the strategy of the current Trump administration is to have enough chaos to create room to operate. I think they would even prefer to have a little bit more certainty just because the economy needs it. If you talk to investment professionals, unbiased, apolitical investment folks, they'll say that really a lot of the actual quantifiable uncertainty is behind us. Tax reform has been passed. So that's on the books. Don't have to wonder about that. We don't have to wonder whether those tax breaks are going to go away. Tariffs, while there's still some volatility here or there, tariffs are mostly behind us. They're mostly kind of set in motion. And there's an idea that they're not going to get so much worse, especially in regards to China, because that really added the most global uncertainty. And then, obviously there's geopolitical issues, but things, or this government shutdown, but those I think will appear to be relatively transient in nature and will move past it. But the general population is not yet to a point of where they're feeling confident in the future. Business owners aren't feeling confident in the future enough to hire. They're not necessarily firing too many people because you want to keep operating. Things aren't horrible, but to make that additional investment, at the same time, every business owner is saying, do I need to rehire that position, or can we replace it with AI? Can someone else do that if they use an AI tool or a virtual assistant? I think we're starting to see some of these, not necessarily complete productivity gains, but we're going to start to see some movement, some quantifiable data to show how more productive we can be using these AI tools over the next 6 to 12 months. And, could a recession be caused because we're in an AI bubble? There's so much hype and cyclical investment going on. Certainly probable. But we start seeing some of these gains. The long-term fundamentals are really exciting for the macro economy if we really start seeing some of these productivity gains. So many individuals were so focused on kind of fighting the last war, and we're really worried about inflation. And I mean, I'm worried about the debt, and I'm worried about inflation. I think we are forgetting how powerful of a deflationary effect technology has on society and the economy. And I just haven't seen anything that would be as deflationary as AI, because you're not just making technology more efficient, you're making people more efficient, and general cost of labor and payroll go down significantly. How society deals with all that will yet to be seen. But I am optimistic that we will see some benefits.